Hi, Steve Van Metre here, and welcome to your Wednesday night premiere. We take about 15 minutes every Monday and Wednesday night trying to make sense of markets that actually might start making sense. No. All right, well, maybe a little bit. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as recognition or solicitation by selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity and opinions of this video, but that do not reflect the view of Alice Financial Advising Inc. or Steven Van Metre Financial. So we had a big press release from the Federal Reserve, who did lower the federal funds rate by 0.25%. How did we know that was likely to happen? Well, because Wall Street gave 100% probabilities into federal funds futures that there would be a cut. And guess what the Fed does? I know you're thinking, I thought the Fed was data dependent. No, they're Wall Street dependent. If Wall Street tells them what to do, the Fed does it. And they did. But what surprised everyone was they ended the balance sheet unwind. Now the Fed said we ended a month early. According to what I know about what they said before, it was 2 months early, but we'll go with what they said. We'll stick with 1 month early, even though they previously said it would end at the end of September, but it doesn't matter. And what that tells you is there's something bigger going on here, and the Fed, like a card player, can't show their hands. See, the Fed said, well, this was a mid-cycle cut. Say, what? A mid-cycle cut? So we're 10 years into a 20-year expansion? I don't think so. We don't have economic cycles that go 20 years long. We've never had one that went that long. Now, we've had bull markets that have gone 20 years, but not without a recession in the middle of it. That's for sure. So now we're being told that this is just, almost like an insurance cut, because there's uncertainties about the global economy, and we've never had to deal with tariffs before. Well, that's funny because the Federal Reserve dealt with tariffs during the Great Depression, but nevertheless, modern day Feds have not. So what's the real reason the Fed is cutting? That's probably what you want to know. And the simple answer is they know something we don't know. And we're going to find out very, very, very soon. Now, what do they know that we don't know? Well, they happen to know what tomorrow's factory PMI service, manufacturing and services PMIs are going to, boy, I goofed that one up completely, didn't I? They know what those are going to show. And based on some of the Fed regional surveys, we already know that they're likely to drop more and maybe even possibly slightly contract. There's a second thing we know, and I'm not as concerned about the factory data. I can tell you that due to the high correlation to 10-year Treasury yields, we already know it's headed lower. But on Friday, we get the non-farm payroll report. He already knows what the number is, or he already knows a very close to final number. And he said, well, how is that possible? Because he picks up the phone, calls the Bureau of Labor Statistics, and says, hey, where are you at with Friday's report? And they tell them. See, the Fed always has advanced data, but again, they can't play their cards. They can't come out and say, hey, we cut because Friday's payroll report's going to be really bad. And everyone will be like, sell, 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 sell. Can't do that. He can't say that. How do we know the payroll report's probably bad? Well, we can revisit a chart that I've shown you that has total construction spending against total non-farm payrolls. One is a percentage change from a year ago, which is total construction spending, and we have non-farm payrolls change from a year ago, 1,000 persons. But let's tweak this to show what you see as the headline number, the actual number. And I wish there was a way to average this within here. I'd have to download it and redo the chart, so we're not going to do that. But what this suggests is that the May payrolls came in at 72,000. Today, the ADP report came in at 154,000. ADP is notoriously off, so that's not a major deal. But based on this relationship, we could see a very, very small increase in employment on Friday. And that would be a really good reason to cut rates. So again, the Fed can't say that. Now the Fed Powell did indicate that perhaps this is just one rate cut. And then he turned around and kind of said, well, that maybe there might be more. He's trying to dance around the fact that he has no clue what he's doing right now. And as a result, the market sold off. That's what happened. So we'll take a look at that. Let's take a look at that right now, as a matter of fact. So here you go, S&P 500, a big red candle down, went from, where did we start the day? 3,017, broke through 3,000 and closed at 2,980. NASDAQ was also down big. The Dow was off over 300 points. And for whatever reason, small caps actually did the best. And as I predicted, interest rates should fall. So we saw, now this is a short-term anomaly. For those of you who are wondering, did I buy the short-term treasuries today? The answer is no, because you normally don't see a big jump in short-term yields. Now, this is not a big jump. It just looks big because it didn't rise nearly as much as it appears here. But the market may have a negative reaction for the next day or two. We'll see. But let's see. 5-year treasury yields closed flat. 10-year treasury yields closed down after butting up against resistance, this little dotted purple line, and headed lower. And 30-year yields broke support and went down. No surprise there at all. So what does all of that say? Well, the normal move when the Fed starts to cut is short-term, mid-term, and long-term yields should fall. So as I mentioned, one of the plays we're looking at probably the next day or two, I can't imagine by Friday, probably tomorrow, but we'll just see how the market digests this overnight and into opening tomorrow, is we'll move the cash into short-term bonds. And again, not a long-term position, but a short-term position. And I'm actually now thinking about using the equity space, which is the cash of the portfolios, to pick up some 30-year zero coupon bonds. And you say, well, why would you want to do that? And I said, well, let me show you. But that is not where I wanted to show you. There, let's go over here. And boom, here is both the effective federal funds rate in blue and 30-year treasury yield in red, and you'll notice they're both on the same side. They're both stated as a percentage, and out of this gap here, and I don't recall what the reasoning, if we didn't have 30-year bonds for a while there, could be. But nevertheless, you can see when the federal funds rate goes down, 30-year yields go down. And so there is money to be made here because the Fed doesn't think they're going to be cutting a whole lot, but the reality is they're probably going to be back to zero by the end of the year, and I'm going to put a case together for why that's going to happen for you next week. But Friday, I do have some cool stuff lined out. So I'm probably going to use some of that position, not immediately, but we'll watch. I'll show you why in the charts in a little bit. But let's take a look real quick at what I forgot to do Monday, which was how the hedge funds are positioned. I got done with a video. I'm like, man, I got done early, 10 minutes. And then I realized I forgot to go over this. So anyways, let's take a look at how hedge funds are positioned. They increased their short position. Again, this would be last week on 10-year treasury yields. So there's a big potential for a short squeeze in yields that could really, really drive yields a lot lower. Hence, with the Fed cutting and the relationship between treasury yields and the federal funds rate means there's a lot of upside potential in bonds, even though people are saying bonds are in a bubble. No. Well, corporate bonds maybe, but not treasury bonds, that's for sure. High yield bonds, yes. Treasuries, no. Here you can see that hedge funds increase their short position on 30-year bonds. And after today's price action, you can go like, they were wrong. Yep, they're going to get squeezed out of this. There's going to be some upside. Let's take a look at oil, which had some big draws now for 2 weeks in a row. I'm hearing that Libya is the reason why we saw there's a production slowdown or something. I didn't bother looking into it. A lot of oil longs that could get pulled out from underneath here. We expect to see that. We could see they went a little bit longer on the S&P 500, not much. And we'll skip to euro. Looking at gold, they're very, very long gold. I said this was a topping pattern. Wait till we get to the charts. You'll see that will make perfect sense. NASDAQ, they're also long there. That got reversed. They're short the Russell, which actually didn't go down that much today. That's interesting, but you can see they're way, way short small caps. And the US dollar rally today looking like it's going to break out. And the VIX or volatility started to rise, and they're very short volatility, which is setting up a big move in the market that could potentially be coming sooner than later. Okay, so we've got about 5 minutes. Perfect. Let's go and dig through some charts. First, let's focus on bonds. Let's start there. Here's the short-term bonds. This is where we're going to head with the cash. You'll notice today it broke through its 50-day moving average and just shortly, minutes into close, it rebounded back. Again, I just want to make sure that this is settling. You'll notice it only moved 0.1%. This isn't a big mover. This isn't a, hey, I'm going to make a lot of money in short-term bonds. This is, I'm going to make a little bit more money than I'd make in cash. That's what we're looking at. But I'm interested in the 30-year zeros, and I'll show you why. Let's zoom out on 10-year. This is 7 to 10-year Treasury bonds. Now, we're no longer in this position, but this is the closest proxy from a bond to 10-year Treasury yields. And you can see that it's nudging to break out of this top structure here. See how we're kind of pushing up? We're getting out of this. So this should start to move up. And if it gets up into, say, probably right around this 110, let's go ahead and move this line up into here. It gets much up past here, and you're going to see a breakout in yields. And bond prices. Let's look at where we did shift the bond portfolio into TLT, the long bond, confirmed its 50-day moving average. I said it would. I was not worried about this. Nice action today when we see, of course, bond prices move up as the market dipped. But you can see all this thing needs to do is just keep chugging along. It doesn't take much for this thing to break out. It's really close to just having a nice shoot higher up here. That shoot higher is what I'm interested in, not only because the specs, hedge funds, speculators are short, but just because there's some other things coming. I don't want to pre-announce. If you read the Facebook post, you might get a grasp of what I'm going to talk about. But for the moment, I don't want to put my cards on the table. Let's go out here and draw not trend line, time level. There it is, price level. So here's 30-year zeros. Just kind of, we're just confirming with compliance that we can go ahead and use these. They're not leveraged, so it should be okay. But anytime you're dealing with insurance, because we have to be insured for everything we do, every trade we put in, we have to make sure that our insurance is comfortable with that. So we're just making sure about this. So it may take some of that in the days or perhaps week that follows, and there's going to be some good reasons. Probably by the end of the month, I want to pick some of that cash that's going into short-term bonds and put it here, because these things, you can look over here. You can see when the bond market moves. See how it moved a lot. It went up plus 1.67% today versus TLT, which was up 0.08. Well, there's a big move coming here too. And I think it's very interesting, and I think it's worth looking at and getting a piece in. All right, 2 minutes left. Let's take a look at gold real quick. As I said, this looked like a topping pattern, not as evident in the price of gold, but very evident in GDX, which was down almost 5% today. Remember, I said it's a topping pattern in the bigger scheme of things. So we had that bottom, higher high, interim bottom, peak, should pull down. Look at silver miners down over 4.5%. Big down. This confirms this is a topping pattern. Silver miners have been leading. We want to find them down here, a place of support. I think that will be very interesting. And look at junior miners again. That's probably the position we'd end up in, over 5.5% down today. This is looking like, again, a top that should unwind. Let's go on to say something. You hear you got the ag commodities that were in this nice, sideways pattern. Looked like they were going to break out, and the momentum investors were able to get it sold down. It's going to find support right in here. This is where the real buyers are at, right down in this, high $15 range. Should see support here because these people are probably not selling. And then by the middle of next month is when we should start to see the field reports, and they're not looking very pretty. Let's take a look at Apple. It broke out of this wedge after earnings. By the way, for those of you who follow Apple, keep in mind that they have purchased $17 billion worth of shares back in the last 3 months. Let me show you. That was here. $17 billion, and they did not get share prices any higher than where they really were 3 months ago. In the last 4 years, they have bought over 1 billion shares back, and their earnings are the same. They are the same. They have not increased. Everyone's like, oh, look at Apple's earnings. They're the same as they were 4 years ago. So where's Apple's stock price headed? And where's the broad market headed? Let me show you. Let's go back 4 years. Here's 2016, 2015. Apple shares most likely going to sit this pattern when it breaks down. Tells us Apple stock's headed way down here, and it's just because they're not making any more money than they were. So they're not, this price move in stocks is not validated. The only way this triangle pattern is validated is if it goes down or reconfirms the slope of this tan line and rallies off it. If it breaks through, forget it. Apple and the rest of the market are headed lower. And last but not least, how did we know that gold was headed lower? Well, there's not a super high, but a good relationship between gold and emerging markets. And you can see there's GLD, the gold ETF. There's the emerging markets ETF. Look, they're not perfect, but it tells you if emerging markets are headed down, so is gold. We want to see emerging markets bottom some. If we got a bottom emerging markets where I've got this grayed area here, that would be probably match the bottom in gold. You can see I've got it drawn down here. That's your bullish indicator. We'll be watching that closely along with some other stuff. So I'll be back with you Friday with why rate cuts lead to recessions. We're going to have a whole bunch of charts. Hopefully you're going to love it. I'll see you Friday. I'm Steve Van Metre. Bye now.